Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And in today's episode, we're going to be looking at 5 compelling reasons to consider gold in your investment portfolio. Gold can be an important diversifier in a portfolio for sure in any market, but we're going to look at what factors are in play currently that lead us to believe why there might be an opportunity for investors in gold now. Just a quick reminder before we get started that we are not providing any investment advice or investment recommendations today. Today is all about providing education and information to Canadian do-it-yourself investors. So joining me today is Bipan, our head of ETF strategy here at BMO. Welcome back to the channel, Bipan. Thanks for joining me.
Good to be here, and thank you for having me on.
As our ETF strategist, a few weeks ago, you came up with sort of these five reasons why investors might consider an allocation to gold. And I thought it would be a great topic for today's conversation. And the first was really around how gold has an inverse correlation with US 10-year real yields. So I'm hoping you can talk us through that, walk us through what you're seeing here and what really explains this relationship.
So that's a great question, Aaron. If we're talking about the inverse relationship between the spot price of gold and long end real yields in the United States, it really helps to frame how investors tend to view long end real yields. And really, for a lot of investors, they signify the trajectory of economic growth in the United States. If we look at the level of real yields now, we're close to 1.6%, which you could argue at this point is slightly below where most would consider trend growth in the U.S. But if there are increased risks about that, with that level of growth that's expected to be anticipated, or to be anticipated, I should say, then real yields in the long end should move lower, and you would expect investors to allocate more and more of their portfolio towards risk haven assets like gold. And that, to me, explains the historical inverse relationship between the two. And remember, if we view gold, it's not just decades worth of experience with gold as a haven. This is something that goes back millennia and is really embedded in the investor psyche. So again, if there is concern about the soft landing narrative, if there are compelling reasons potentially to be worried about the trajectory of economic growth in the United States, those should be reflected in forward-looking expectations for real yields in the United States. And we'd expect to see gold's desirability as a haven increase in response.
Awesome. Okay, great. That makes sense. And then how does this correlation change? Obviously, we had the Fed cutting rates last week, which you called. You called the 50 basis point cut. So well done on that. But how does this correlation change when we're facing a declining rate environment?
So one thing to remember is that gold doesn't yield as an asset. It's quite different from bonds or even some dividend equities or equities that provide dividends. So, the further and further we get in the Fed easing cycle, that becomes an easier decision to make, to swap out something that, an investment product that does yield, say 2 to 3%, for something that yields nothing, such as gold. And again, remember that this also dovetails nicely with gold's application as a haven ballast for investor portfolios as well. So I would anticipate that, the further we go along this Fed easing cycle, the more interest rates move lower, the inverse correlation between long end real yields and gold should increase as well.
Okay, great. And then another factor that you point to is sort of the general risk that the U.S. economy slows from here and the impact to gold. So kind of a loaded question, but what is your expectation for U.S. markets and how does this present sort of as an opportunity for an exposure in gold?
So we have to take things into context. If we look at the level of U.S. activity right now, we're tracking close to 2%, which any economist or strategist will tell you is reasonably healthy for a developed market economy at this stage in the cycle, in the monetary policy cycle, I should say. But, below the surface, if we look at things from, let's say, a labor market backdrop, there's signs of strain. The unemployment rate has been moving higher as new entrants in the labor market have been struggling to find jobs, let's say, at the margin. That shows signs that also that the labor market is having trouble absorbing these new entrants as well. And that could be, the early stages of a slowing backdrop, in which case, that's it might lead to an environment where the Fed will have to ease even below the anticipated neutral rate, which is something that they're very very they're cautious about. So with that in mind, if let's say we are in this backdrop where the labor market does continue to struggle and the Fed is forced to cut or ease rates by even more than anticipated right now, there are upside risks for gold prices as well. And the conduit to that would be via a weaker U.S. dollar, because again, unanticipated Fed easing will show up in the currency market first. And again, because of the fact that gold is denominated in U.S. dollars, I mean, that could be another reason potentially for upside if the backdrop in the United States does weaken materially from here.
Okay, great. And I know we often look at gold as a store of value, given its finite availability in the world. It was once said to me that if we put all the gold that was ever mined, it would fill just over 3 Olympic-sized swimming pools, I believe it was. So an interesting way to look at it. But walk us through how sort of the Fed's general approach to quantitative easing over the years has led to this fear of the U.S. dollar weakening over the long term, and how gold plays into this equation.
So let's keep in mind that over the past 15 years, the Fed has changed the way that it approaches policy. It's not just about discrete interest rate cuts anymore. A lot of the way that the Fed does address its policy goals and its mandate is via changes in the underlying balance sheet. And one part of that has been the quantitative easing that we've seen over the past 15 years through various episodes. And really, what that is a method for the Fed to control interest rates, or albeit in an indirect manner, further out the curve than just the front end. And the way it does that is by going into the secondary market and buying up treasuries and mortgage-backed securities. Let's remember that liabilities are now structurally higher, primarily because the level of reserves in the U.S. banking system are higher. But also, if we look at the degree or the quality of assets held on the Fed's balance sheet, those are lower in quality than they were pre-2008. And as an example of that, we can point to, in prior instances where the Fed has had to deal with crises and slowdowns, that's meant accepting collateral that was poor in quality, including high yield corporate debt. That wasn't really the case pre-2008, but it engenders this feeling that the assets held by the Fed since 2008 are poor in quality. Now, it could be one of the main reasons why the correlation between the growth in assets in the Fed's balance sheet has also increased alongside gold prices as well. And that could be another reason why we see some of these other peripheral assets outperform during periods when the Fed's balance sheet is expanding. So, any sort of serious understanding of how gold prices move needs to take into account of how the Fed's balance sheet has changed structurally and materially from where it was pre-2008.
Okay, thanks, Bipan. And then how are you seeing other countries behave when it comes to their holdings in these U.S. dollar-denominated reserves? And are you of the view that USD will lose its reserve currency status?
So what we've seen over the past couple of decades is that a lot of foreign central banks have been reducing the composition of their reserve holdings in terms of U.S. dollar and really diversifying into other currencies. That makes sense. If we look at the geopolitical landscape over the last couple of decades, we've seen the United States kind of lose its luster as the sole, superpower when it comes to decision making in sort of the geopolitical space. Also, we've seen the growth in other countries' external debt markets as well. And I think that's part and parcel to this sort of decline that we've seen in reserve holdings when it comes to the U.S. dollar. Now, extrapolating that out into the future, very difficult to do. But we don't think that the U.S. dollar is going to lose its luster as part of the reserve basket. We might be in this sort of multipolar world when it comes to reserve currencies, and the U.S. dollar is always going to be an important part of that. And I say that for several reasons, and kind of listing them out here. I hope you don't mind if I look down at my notes here, but it's if we look at just the ability to conduct business internationally, it's always easier to do so in terms of US dollars. So there is that network externality approach when it comes to settling cross-border trade that reduces costs when it's done in US dollars. Also, let's remember, if we look at the US Treasury market, it's very liquid and it's very safe. And that is going to be something that's going to be very, very hard for another country's debt market to sort of upend. So there is always going to be this sort of reason to have US Treasuries as part of any portfolio. And the other angle to remember as well is that it's not just about reserve holdings when it comes to the dollar's primacy when it comes to the reserve markets. One of the other interesting wrinkles to the story is the heavy degree of debt that's denominated in US dollars that's held outside the United States, right? So if we look at anybody that owes money, outside the US, a good chunk of it, we estimate around $12 trillion US dollars worth, is denominated in US dollars, which means there's always going to be that sort of demand for sourcing US dollars. And again, that tells me that there is going to be demand for USD, and it's going to be an important part of the reserve basket for many, many years to come. Now, what we've seen primarily over the past 10 to 15 years has been the sort of shift away out of the US dollar, that diversification into gold. That's been done for the most part by central banks of countries that aren't necessarily geopolitically aligned with the United States, and potentially to get or some concern now being reflected by the weaponization of sanctions used by the U.S. Can that continue in the future? Most likely, yes. And, at the margin, it also tells us that that should underpin another reason to remain long gold over the next little while.
Another reason why gold as a diversifier makes sense. Any other factors, Bipan, to consider if investors are looking to add gold to their portfolios? Anything else you want to add?
No, I think we've covered all the major ones there. And I mean, and it's worth highlighting them again. You want to look at the trajectory of interest rates in the long end of the curve, primarily real interest rates, which are, of course, adjusted for inflation. You want to look at the trajectory of the US dollar. And that, of course, is going to be reflected by what's happening with respect to the Fed, among other factors as well. And fundamental supply-demand dynamics, including central bank demand, and whether or not that's going to shift materially over the next little while, as well as what the Fed is doing with its balance sheet. I think those are the primary factors to focus on in the next little while, and could portend to another potential leg higher for gold prices after this current period of consolidation.
Okay, we'll be watching. And for investors who are watching that are looking for an ETF to gain exposure to gold, BMO launched this year's ZGLD, our BMO Gold Bullion ETF, which is definitely one to check out. We also have two other options for gold exposure, one being an ETF that provides exposure to global gold mining companies, so the actual equities. That's our BMO Equal Weight Global Gold Index ETF, ZGD. Or if you're looking at gaining exposure to some of the smaller cap junior gold names or the explorers, that would be ZJG, our Junior Gold Index ETF. So that sort of covers off the three ways to access it with BMO. And we also offer a lot of different currency hedging options when it comes to those exposures too. Thanks so much, Bipan, for joining us today and giving us all your great insights on gold and what's going on in the US markets. Looking forward to having you back again soon.
My pleasure. Thank you.
And thanks to our viewers for joining us today. We'll see you next time. If you haven't already, please remember to hit subscribe to our channel. That way you'll be notified each and every week as our new episodes go live. Thanks for tuning in. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.